Good day to one and all. This is Dr. Sivaraman of iknowindices.com. I'm audible to you. Good day, Sandra. Thanks for confirming the audibility. Let me display the PowerPoint presentation. Asian session live market analysis on January 16th. The webinar is between 5 and 5:30 GMT. We will review the market on a daily basis using the live market code page provided by Saxo Bank and which is available in iknowindices.com. I'll give the link for the same and I'll go back to that of the PowerPoint presentation. So in the live market code page, you can open the live market code page. Meanwhile, I'll explain to you how exactly this code page has to be used. We note down the high and the low between 2:30 and 3:30 GMT in 4 majors and 2 commodity pairs. So that is Euro GBP, USD Yen and USD CHF, and also the 2 commodity pairs, Australian dollar and Canadian dollar. Around 3:30 GMT, the high and the low are set. They are referred as the initial lows and the highs. So the low may be set around 2:30 GMT and the high may be set around 3:30 GMT, doesn't matter. By 3:30 GMT, if we note down, that becomes the initial low and the high. Why we need to note down the initial low and the high by 3:30 GMT? Because some people might be having a doubt, what is the significance of this particular time? Around 0030 GMT, the low and the high are being fixed by that of the interbank treasury. Depending upon the previous day, the market moves in the last 30 minutes. The last 30 minutes move, the high of that, average high of that particular 30 minutes move, and the low, average low of that 30 minutes move is being noted down, and also the closing price. All these three prices are given by that of the interbank treasury, and that is being shown as the startup low and the high. Then subsequently you find the net changes are being calculated. Currently you come across zero is showing a net change of 31 pips. Negative, that is in red. That means from the Friday close, euro has dropped about 31 pips at the current level. That is what it refers to. Then what the players do, they just make the widening the spread between the high and the low by making an upward move and a downward move and stabilize it around 3:30 GMT. And that is being used as a reference level by that of the players for their various purposes. I cannot disclose all here in an open meeting. Then once they set the highs and the lows, and that is being used as a reference level, then subsequently they make either a downward move from that of the initial low or an upward move from that of the initial high and continue to form the new high or the new low depending upon the market sentiments they try to create and act against. So that is why we make a note as they are using this 3:30 GMT, the initial low and the high, for their market moves. So we also note down in order to read what sort of market moves they could do it. So we use them as the reference levels for the day to identify the type and the sequence of market moves. So the type of market moves and the sequence of such market moves are very important for us to understand. So once we follow that type of move, so initially they do a stop it. Then followed by that, there could be an extended move or there could be a false move up to that of the high. Say for example, they have the initial low and the high, then subsequently from the high they come down and make to that of the low and make a downward stop. Then what they do, either they go up to that of the initial low or up to that of the initial high and come down again without breaching the high. Then it becomes a false move, the stop point on the downside, then a false move up to that of the high, then come down very quickly in 30 minutes and go below that of the initial low. Then they make an extended move on the downside. So once they make the extended move prevails for 2 hours. Then after the 2 hours If they stop cutting the low, new low formed, that means they are expected to reverse, come up to that of the initial low and stay above that initial low for 30 minutes. Then subsequently they go above the high and stay above the high for 30 minutes. So this is mainly to induce the traders to either book profit or to take further averaging shots. In case if the traders are sellers, in case if the traders are buyers, out of fear because the entire world is talking bearish about euro. So obviously anybody has got the buy position will try to exit during a small rise up to that of the high. They want them to do that. Then subsequently they gain the levels once the traders predominantly take sell positions. Otherwise they just continue to drop if the predominant of the traders going for a breakout trade buy above that of the high as a breakout trade expecting further rise to book profit. Then if all traders turn long above that of the initial high, then they don't stay there for more than 30 minutes and try to slowly come down and come to that of the low. This is how they change the market moves from time to time. This we need to read it beforehand in order to commit positions. That is why we follow the session timing, and during the early session and the late sessions they handle the majors. Mid session they have to handle the crosses when the volume comes down. So initially if they just make an upward stop and or a downward stop and the trigger, market trigger could be given. But subsequently till the end of the session for about 7 to 8 hours they have to make swings in the market. They cannot continuously rise 24 hours or continuously drop 24 hours. And it becomes meaningless or the moves will become visible. So they don't do such moves and they only just hold and make a small firming up move or make a small dip and just create uncertainty to the traders. So the entire market strategy by that of the player is continue to give uncertainty to that of the traders whether euro is going expected to go up or come down. Only when the uncertainty is given and then any breakout news is used as a trigger for them to make an upward move in a surprised way or a downward move. So that is why either a trader has got a sell and buy position or a sell position or a buy position, they continue to face surprise in the market. So you find every trader, either he is doing a buy and sell trade or a sell and buy trade, becomes nervous in the market. So ultimately, what is going to be important for us is, in order to get rid of that nervousness or the market fear, we need to identify the possible trade, either a sell and buy trade or a buy and sell trade, depending upon the market type of moves, initial moves. Then we derive from there the sequence of moves they could do it. Either an extended move, followed by that of a downward stop and then further extension as an intentional move, or an extended move upward and then subsequently drop and continue it on the downside. These things from session to session we can read it following the session timing. These session timings are followed by that of the players. So we follow that their initial lows and the highs. We follow the session timings, which may be different from that of what others talk about as Asian session, Japanese session, European session, UK session, New York session, etc. They may differ, but ultimately what the players follow, we need to follow in order to understand their intentions. Because we are deriving their intentions from their market moves. Because whatever be the hidden agenda, they have to expose it in the market. And as we know that the market is being driven either on the upside or on the downside by human beings and not by God. So obviously we understand that in order to make an upward move or a downward move in the market, they have to make a cunning way of a stop and opposite to that. So if they want to gain the levels, they will make a downward stop and a false move and then go up. Or if they want to drop the market, if all the traders have turned long, then they make an upward stop and or a false move up to the high and start making that drop. So this we have to derive it from the market moves. So whatever be the hidden agenda, the first move will indicate the upward stoppant or a downward stoppant. If it is an upward stoppant, understand that if less than 30 minutes, if the market comes below that of the initial high, then we understand that they wanted to make a downward move. Similarly, if they make a downward stoppant and in less than 30 minutes they come above that of the initial low, then we understand they want to make an upward move. So based on that, we try to commit a position. So when they quickly make a downward stoppant, we take a buy, or if they quickly make an upward stoppant, try to take a sell. So initially, without taking position, we just watch the timing of the market. In first 10 minutes, they will form the new high. Afterwards, they will stop cutting the high. Then slowly come down and come below that of the initial high. Then we understand the first 10 minutes move will indicate whether it is a stoppant or not. They continue to breach that high, new high, after 10 minutes, then understand it could be an extended move for 2 hours. Don't immediately, don't commit in a hurry, a sell position. Wait for them to settle and not cut the new high for more than 30 minutes. Then you try to take a sell position. This is how we watch the market and try to take the positions, and we don't go by that of the emotions created in the market or the sentiments created in the market, because we know very well the players create the sentiments and act against that of the traders once the traders commit the position. So once we decide upon the entry, still we don't become 100% confident, or we don't just like that keep open position without any risk management. So risk management is the most important thing, because we are all having smaller equity to trade in a bigger market. It is something like a small boat. We try to use it in order to cross the ocean. So obviously we have to be doubly cautious, and we have to see from time to time the boat does not capsize. So that is very important. So for that, what we do is we try to determine the risk, how much of risk I am going to take. So at a given time, 30 pips. So entry stop or a stop can be placed 30 pips below that of the market if you have taken a buy position. And entry stop is nothing but a hedging order, or a stop is a physical stop. So once it is filled, then the position, original buy position will be closed. And that is referred as a stop. And in the entry stop order, once the original position buy is there, and when the market goes down, if it fills the sell position, sell order, then you hold a higher level buy, a lower level sell position. Only if you hold the positions, we will be able to trade in the market. The position is closed, then we don't have any opportunity to trade in the market unless and otherwise we commit a fresh position. So if you are stopped out, invariably we hesitate entering into the market. Instead, if you use the hedging, then we try to review the market based on the buy as well as the sell positions, which way the market could be taken up, either on the downside or on the upside. There are only two possibilities. They can either continue to drop or continue to rise. So understanding the type of moves they could do it, we try to open or close the hedging position and keep fresh hedging order below that market, 30 pips below the market, so that we don't take further risk of 30. We don't take a risk beyond 30 pips at a given time. And once the position makes profit, if we keep a hedging order, and once the buy position makes profit of 20-25 pips, we keep stop at entry in the position, buy position, and remove the hedging order. So the hedging order is used instead of a stop at that time. Then we continue to book profit or just trail the stop in a profit-making buy position or a sell position, whatever it is. So when we enter during the start of the session or the end of the session, when they make a quick move. So during the start of the session, if they make an upward quick move, we try to take a sell position. During the start of the session, if they make a quick downward move, we try to take a buy position. So that when you understand this is how we trade, we don't do wrong trades. So let me go back to that of the PowerPoint presentation, because many of the people still find it difficult to understand the simple strategy what I have been explaining in order to read the type of moves in the market, because ultimately the type of moves, if you recognize, then it becomes a child's play for you to trade in the market. Now I have focused the camera over that of the live market code page. Currently you come across euro is trading around 1.264345, 1.2627 is the low, 1.2659 is the high, and you come across 31 pips negative exchange is seen. From the Friday close, euro has dropped about 31 pips because of the S&P downgrade, and people were expecting more drop, probably euro to go to 1.2524 like that, but they made a very subdued drop of 30 pips like any other day. And one reason could be it is a holiday in US, so thin volume. So that could be the reason. So let us keep our mind open and let us not have any prejudice or just have a one-sided view, and let us see how exactly they are expected to make the moves during the day in a thin volume condition. Then GBP is trading around 1.5306, 1.5310, 1.5277 is the low, 1.5318 is the high, and 8 touch negative net change is seen. And it might be the downgrade with regard to euro, but in tandem with that of the sentiment created, GBP acts as the sentiment creator, which has also made the drop. It is not holding higher level or gaining. Instead, it has also made the drop. But USDN has also dropped, and it is trading around 76.80, 76.83, 76.82 is the low, 77.11 is the high. 14 pips negative net change is seen. Now the spread is slightly improved between the low and the high. It is, when compared to that of 8 to 10 pips, it has come to about 20-22 pips. So now you can understand that they are making a contrarian move, because the euro and GBP are showing the USD gaining move, whereas USDN is showing USD weakening move. So it is referred as a contrarian move. When they make a contrarian move, we know that they are handling the respective cross. So by dipping euro and USDN, they are dipped euro yen, and similarly GBP dip and USDN dip has made that further dip in the case of GBP yen. So this is how you find an Australian dollar dip and also yen dip, you find Aussie yen dip. So you find the negative net changes with regard to these yen crosses, because week beginning they wanted to handle the yen crosses. So when the week beginning they handled it on the downside, understand they want to do an upward move in them. So normally they do the week beginning false move in the case of the majors as well as the commodity pairs and also the crosses. So now week beginning they are making a dip in the case of the yen cross. Understand that they wanted to make a drop now and later on gain the levels during the course of the week. And in the case of USD CHF, 95.42, 95.45 are the current levels, 95.34 is the low, 95.61 is the high, and 23 pips positive net change is seen. When the euro has dropped about 31 pips, USD CHF has just gained only about 23 pips lesser when compared to that of the negative net change seen in the case of euro. So because of that, euro CHF has also made that dip, and it has come below the psychological level 1.21, and it has come to 1.2066. As I explained, the week beginning they are trying to make the false move. And in the case of euro GBP, less drop in the case of GBP and more drop in the case of euro. As a result, euro GBP has come down to 82.58, 82.61, 82.58 is the low, 82.72 is the high. So as in the case of euro GBP, they will not continue to drop, and they have to make the swings, and they have to induce the traders to take long positions before making further drop. So they are expected to go to 83.50 or so, and then later on drop it, as they have done it in the case of euro CHF. Come below that of 1.21, and later on they wanted to gain the levels. So they are doing a prolonged consolidation in euro CHF current level around 1.21, and then later on during the course of the week we could be able to see that it's going to higher levels. Then coming to that other commodity pairs, USD CAD 1.0223, 1.0227 are the current levels, and 1.0226 is the low, 1.0251 is the high. 7 pips negative net change is seen. When USD CAD and Australian dollar are showing the negative net change, that means it is yet another contrarian move, because USD CAD is showing the USD weakening move and Australian dollar is showing the USD gaining move by making a drop. So when both are showing the contrarian move, then we understand it is to handle the respective commodity crosses as well. So Australian dollar is trading around 1.0282, 1.0285, 1.0256 is the low, 1.0303 is the high, 38 pips negative net change is seen. So when they are handling crosses, there is no point in taking positions in the majors. We have to wait for the late sessions to see how exactly they are going to handle the majors. So when they are done, not breach the low or the high, in the case of Euro and GBP, how we know that? We will go back to that of what the levels they have shown it during that of the 3:30 GMT time frame. So 3:30, this is the level. These are all the levels I have noted down by 3:30 GMT in the case of all the four majors and two commodity pairs. Euro formed at the low 1.2627, which is not breached. 1.2659 is the high, which is also not breached. Currently, you can see in the live market code page, the same lows and the highs are seen. In the case of GBP also, the same lows and the highs. And USDN also, USDN, they breached the low by 1 pip just to handle the N crosses, and the high is intact. And in the case of CHF, the low 95.34, 95.61 high are not breached. Canadian dollar 1.0225. Sorry, 02. I think there's an error. 1.0226 and 1.0251 are not breached. And in the case of Australian dollar, 1.0256 and 1.0303 are not breached. So excepting yen by 1 pip, all other pairs, they are not breached the high or the low. That shows that they are making only swings between the low and the high and holding mostly the market in the middle level between the high and the low. So if you try to commit any position during that time, you will not make any profit anyway, because obviously they are expected to make 5 pips dip and 5 pips gain, and maximum you can earn about 2 to 3 pips or 4 pips, discounting the spread between the bid and the ask. So there is no point in taking positions. As I explained, that only when they make a very quick move, either on the upside or on the downside, we will try to initiate a position. Now, how exactly we decide the trading strategy? We have the initial lows and the highs, and they are not breached them, so we simply watch, wait for the late session. Once the late session comes, if they come closer to low or closer to high, we will watch whether they are come up to that of the low and not breach the low in 30 minutes time frame. That means it was only a false move up to the low, and later on they wanted to gain the level. If they are not breached it in first 10 minutes, and if you watch for 30 minutes also, if they don't breach the low, you can commit a buy position near that of the low. In case by the late session they come up to that of the high and not breach the high for more than 30 minutes, then we understand that just they made a false move up to that of the high in order to make a drop. So we can understand when they are making the move in between the initial low and the high, this is what they do it. In case if they breach the low during the late session and stay below that for more than 30 minutes, that means they wanted to make initially an extended move for 2 hours, a swing lower at a lower level. So once they breach the low and stay below there for more than 30 minutes, wait for them to complete the downward move. Till the last 30 minutes of the 2 hours, during that time they should not breach the low. Last 30 minutes of your observation. Suppose they breach the low around 6:30 GMT. Then up to 8:30 GMT, 2 hours from there, You have to watch. And if they don't breach the new low by 8:30 GMT, you can commit a buy position there. Then they are expected to come up. In case if they breach it, understand for 2 sessions they are going to drop it. Simply take a sell position there. You'll be able to see that slowly they come down for the whole of European session and then US session, because 2 sessions they do it. And the start of the 3rd session they do it on the downside, an extend or an intentional. Then that means they wanted to drop it for about complete 2 sessions and start of the 3rd session. Till such time you can hold the sell and try to book profit. Or the buy in case if they breach the high and go above and continue to cut the high. After 2 hours, that means they wanted to intentionally rise for 2 sessions. Then don't be in a hurry to book profit. You keep stop entry and move the stop to that of the initial high or slightly above the first high what they are shown, and try to wait for them to show the new high. Then once the new high is not being breached for 30 minutes of your observation, in the 3rd session, just close it. So this is how we can decide on the trade. Because when I give it in separate context, people are not in a position to understand, I suppose. So because out of market fear, I understand that they'll be really jittery and the mind may not be able to understand so easily even the simplest concept given to them. So that is why I thought that using the initial low and the high, I can explain it again and again so that the traders can understand and get rid of the market fear. My basic intention is to eliminate the market fear from that of the traders. Then we use the forecast algorithm as a guiding factor, and we don't fully depend on that. We only use it as a guiding factor. And the forecast algorithm says that these are all the session times I have given it. For those who are joined and do not know what are the session times, either they can just refer to that of the Tracking the Forex Market Together webinar, what I have given earlier occasion. They are available in archives in FX Street, but I know very well predominant of the traders, they don't do any of the research or understanding, and they want to know whether the euro will go up or come down. That is all. So obviously they don't read any of the past content, and they think that that may not help. But especially with regard to the trading strategy, one need to understand it fully. So that is why I have given it here itself as a ready reckoner for you to just refer the session times. So today, during that of the Japanese session, swing and slide moves are expected, and a quick drop could be seen as a weak beginning false move during that of the early European session, and a quick rise may be seen during that of the late European session. And volatile move could be seen during that of the US session, creating an uncertainty, and slowly they may firm up. So weak beginning false move may be seen during late Japanese and early European session. And today it happened to be the holiday in US because of Martin Luther King Day. So if the volume comes down drastically, then tomorrow they could do yet another weak beginning false move. And that weak beginning false move may be seen during that of the Japanese session. A quick downward move and then follow up a rise. And I'm not expecting a very big drop because the news was of Saturday and Friday and Saturday, the downgrade news, and probably when the news is being digested by that of the market, then the players may simply say that already the news, the price has got the built-in of that particular information. Otherwise, it is the price or the news is discounted. So if they give such interpretation, the news is being discounted and they are looking for further data release and also rumors, news, etc., then they may make their own move. If all traders have become bearish, and the players may simply gain the levels and say that all such bad news are being discounted. So, you know that during non-farm payroll, when everybody was expecting euro to go up with a feel that there could be a risk appetite, then for the trade deficit, they simply say that risk aversion. That's how it is. So when US data was negative, they said risk aversion. So both the cases, for good non-farm payroll, euro dropped, and for bad US trade deficit data, euro fell. So you can understand, predominant of the traders were long, that is why they have made the drop. So when people think that whatever be the news, euro is going to drop and try to dump all the long positions and take sell positions, the players happily buy and gain the levels and simply say that all such bad news are being discounted. So that is market. Keep it in mind that whatever the sentiment we see in the market is not true. They create the sentiment and act against that of the traders. I am not asking you to discount the sentiment, but be alert. So contrarian moves are expected to happen in the market, as you see, and throughout this year, it is expected to happen. And this week, Friday, I'll be giving the forecast for the year 2012. So on Friday, instead of giving the Tracking the Forex Market Together webinar between 9 and 9:45 and 14 and 14:45 GMT, I'll be giving the forecast for the year 2012. So there again, that is based on the algorithm. I will just give you the outline, how exactly the market is expected to behave, what are the events could happen and things like that. And they are all nothing but the guiding factor. Don't go by it fully, but you can just make a note of it and use it for your trading decisions, but still keep in mind that the market can go against any of the analysis for that matter. Let me minimize the PowerPoint presentation and take up the questions which are asked here. Meanwhile, I'll focus the camera over that of the live market first page. Jack, I think I explained what you wanted, why we note down the initial lows and the highs. Then David has got it. The gap time moves are false moves. As I explained that the gap time moves during that of the first week and the last week may not be the false move. So they may commence the move straight away from that of the gap time. But during second and third week, mostly you will come across gap time moves or false moves. Then Casey. Euro started falling from Japanese gap time last Thursday and continued to fall until your session. Yeah, sometimes it happens. So gap time moves or false move is only a guiding factor, a concept. So we have to watch it in first 10 minutes, understand whether they intend to make a false move or just continue the move. And gap time trades are to be closed within the first 30 minutes of the session. It is not validated after that. Then TISM. So after a downward extended move, we should wait for ask price to go above the initial low, yes. And say above for 30 minutes, yes. So that means 1 hour you have to wait. Only then you can commit a position to take a long position. You are right. Because sometimes they come up to that of the initial high and go above that. In 10 minutes they come below that of the initial low. These are all nothing but the deceiving strategies. No, it just cheat the traders or misguide the traders as if they are going to quickly rise it and they may continue the drop. Then yes. What about USD CHF move? USD CHF is expected to gain more levels to start with when Euro and GBP are making a dip. Then afterwards they are expected to hold them at a higher level when Euro and GBP during the late European session start gaining the levels again. Then Jack, do you think USD INR can go to 53, 54 levels? It is very unlikely and they are expected to make a stronger INR in coming days. Then rather, other players going to show new lows in euro, maybe 1.2450. See, anything is possible in the market in case if they find plenty of stocks are there and they find it as a great buy opportunity. Because otherwise, if you are asked to sell, you are not selling. So they drop it deep so that automatically you sell because of the margin fear. So that's how they do it. And so it all depends upon the trader's pending positions. The levels are being determined depending upon the traders holding positions and also the traders holding positions without stop. And in the event, they can make such moves. In case this euro will hit 25.80, there is a possibility during the early European session. But don't think that the bearishness is going to sustain forever. And they are expected to suddenly make a reversal in the market. It becomes a market patient. Okay. So no more questions. So let me go back to that of the PowerPoint presentation. Okay. As I explained in the beginning, that reading the type of moves and the sequence of moves is very important for us to do the market reading. Besides, we also use the GMT time frame of each of the sessions and synchronize with it of the type of moves and then accordingly take the trading decisions. Even doing perfectly all those things, still there can be an element of error because of our objectivity. Market is known to make some surprise moves, so we do not want to get trapped in that. So we keep stop to limit the risk. Whether you do a buy and sell trade or a sell and buy trade, we try to keep 30 pips stop. If the hedging facility is available, we try to use the hedging so that either way we will be having the position, a buy as well as a sell. You can book profit in the buy as well as the sell alternatively during the volatile moves of the market and find the volatility as a great earning opportunity. So once you develop the insight of that nature, that volatility is a great earning opportunity, then you will find trading becomes an easy way of making money. You have to get rid of the market fear for that. And once the position makes profit, we use the trailing stop so that we don't take a chance of protecting our profit. Use a trailing stop of 15 pips from the other market. And once the market reverses, our trailing stop will be hit so that our profit is protected. And don't have any sentimental attachment to any of these levels. They keep visiting the levels or show new levels in the market. That is how they try to convince the traders or try to induce the traders to become bullish and bearish. No? When euro is around 1.28, people might think that it is a good buy level. And once it comes to 1.26 and go back to 1.28, we feel it is a good sell level. So that is how the market perception continue to change. So they have various mechanisms to change our mindset to become trapped. So whenever they make a quick move, understand quick moves are false moves in the market. When they quickly drop, they buy. When they quickly rise, we know very well they want to do an upward stop and then drop it like what they had done it on Friday. So we try to book profit in that position. So initial lows and the highs, excepting yen, they have not breached the low or the high. One of the condition or one of the excuses may be it is a low volume due to holiday in the US. So not many traders might commit positions, and then in that case, subdued moves could be seen today. But tomorrow, they are expected to make very volatile move. A big beginning false move may be seen during that of the Japanese session, during the start. They may set the initial low on the high with a spread of 45 to 50 pips straight away before 3:30 GMT and start making big moves. And Wednesday onwards, they are expected to show USD gaining move. Wednesday, Thursday and Friday. USD weakening move. So let us see how exactly they are doing it. Depending upon the volume, it might be delayed, but the yearly trend reversal normally prevails for about 2 weeks. So the first 2 weeks are over. From this week onwards, they are expected to show their intentional moves very clearly. So let us hope for the best. So today, during the Japanese session, swing and slide moves are expected, and quick drop and a quick rise are expected during that of the European session, and little bit of volatile moves and then a rise are expected during that of the US session. So I take this opportunity to thank FX Trade for this facility of providing the webinars to you, and also you people who have come here to listen to my webinar to understand how exactly you can earn money from the other market with more and more of objectivity without any bias. So we'll meet again tomorrow and review the market using the live market code page as a single tool and identify the type of moves they do it and reflect on what they have done during Monday, the week beginning, so that we'll be able to get a greater insight as the days proceed. Thank you one and all. See you tomorrow.